Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Hello, welcome back, everybody. Sorry about that. Just having a little tech issues here. At the exact right time, the computer goes down. So it's actually coming back up now, so we should have it here in the next few minutes. But it's funny, once you're used to using these things, it gets really difficult to do your work without them. And especially when you're looking at investments, that is that's really tough. Now, having said that, I want to tell you about something that we decided to do. It's probably just a couple months ago. In fact, we're still learning the platform, and there's a platform that's available to us through one of our custodians, and they do some really interesting things with it. So I know these days, every penny counts. You want to make as much as you can. You don't want to take too much risk. That's an individual thing, incidentally. But these models have the best risk-adjusted returns that I've seen. And if you don't know what risk-adjusted returns are, it's basically just how much does that thing fluctuate and how much is it producing as far as returns go. It's really complicated. I won't bore you with all the details right here today. But essentially what you're trying to do is get the maximum returns for the amount of risk that you're taking. And that's one of the things that after all these years, I think I started this show in 1996, and I'm pretty sure I did. And it was with a different radio station at the time, but the staff there've been so many changes, so many buyouts and that kind of stuff. I'm still with the same people that I've been with since the beginning of the show. That is amazing, absolutely amazing. And man, what have we seen a lot? And you're going to see a lot. Next 10, 20 years. There are enough drivers in the economy to keep things going. It's going to be volatile. It's always been volatile. It's never not been volatile. Actually, I think the volatility levels, believe it or not, are actually a little less now than they were when I was first starting in this industry, if you can believe that or not. And I think a large part of it was people really couldn't see what was going on because you only got one statement a quarter. You got one statement every 3 months. So you weren't able to, there was no logging on and watching your portfolio. I'm really aging myself now. But I don't care. And now you see what's happening. And by the way, it's not a good thing. I mean, if you look at the returns that people used to get relative to the returns that they're getting today, they're not doing as well as they did, as our parents did. And it's because they've got too much information, and it's going 24/7, and they're basically spinning their wheels. So that's why it's important when you get closer to retirement age. It's really important that you've got some really good, solid strategies in place, and you leave them alone. And I think that's it's more of a psychological issue than it is anything else. And any really good investors that have been around for a long time will tell you, yeah, it's in your head. The math behind all this stuff is not all that complicated. Now, some of it is, and they do that kind of stuff on purpose. But if you're really sophisticated, you don't really need that kind of stuff. You don't need to know what the discounted cash flow calculations are going to be. For any companies, they're wrong more than they're right anyway. And you just need to know that you're doing the right things in the long run. And is there risk? Yeah, there's risk involved. When you're looking at stocks, there's always risk involved. And stocks are typically, if the economy does fairly well, then stock markets have a tendency to do well. If the economy does fairly well, bond markets have a tendency to do well. When you get a lot of chaos, like what we have right now, well, that's what annuities were invented for. Now, I'm laughing about that, but it's actually true. Yeah, annuities were invented to be able to give people options to be able to invest their money, get a return on their money, get a return of their money, to provide guaranteed lifetime incomes until they pass away. And you can do that any number of ways. That's one of the things that's very difficult to talk about on a radio program, because there's so many various options that you have. You don't have to take any money at all. In that case, it grows on a tax-deferred basis. You don't get a 1099. That money stays in there and earns more money. The interest rates are typically, most of the time, they're either at or ahead of where short-term CDs are, but not always. So sometimes they're larger than that. Sometimes you can get guarantees on the income level. There are a lot of different things that you can do, and that's one of those things where you really need to talk to somebody who does a lot with those products, because they are complicated, incredibly complicated. So you kind of have to know what it is that you want to get. That's and that's pretty difficult. Most people want everything. They want it to do everything. Well, nothing does everything. I'm sorry about that. And but so you have to figure out what's most important. And for a lot of people, it's, I think when I turn 67, I'm going to retire, or I'm 62 and I get Social Security, I'm going to retire. And I need about, $20,000 in income. All right, divide 20,000 by the amount of income that you can get, and that would tell you, by the interest rate that you're going to get, that would tell you what you would need today to be able to purchase an annuity and get the income, and that will guarantee the income that you needed in addition to whatever pension, Social Security you had. And so you would make it. Now, you still have to worry about, you don't have to worry about it, but you need to invest some of the money that's going to grow a little bit faster, hopefully, over time, because you're going to have inflation. So a portion of your money is going to have to go into some sort of a managed stock account portfolio, whatever that is. We've got several of them, and they all include market cap weighted indexes, index funds. It's funny, here's a really common mistake a lot of people make. They'll look at it and they say, well, we should just buy index funds. And what they're really saying is, I only want to buy the S&P 500. They don't know about all the other index funds. There are 3,000 of them. So when they say, well, I think we're just going to buy index funds, what they mean is, I'm going to buy the S&P 500 because I hear that one is really tough to beat. And it is tough to beat. It also goes down 50% or more, or it has 3 or 4 times in my lifetime, and takes a decade or more to make the money back. Okay, so When you get closer to retirement age, that may not be such a good thing. If you're in your mid-30s, that's not fun. That's one of the reasons that when you come in, we're going to talk about that kind of stuff. What should you do? How much money should you put in stocks to begin with? Because we know they're going to fluctuate. There's an extremely high probability that somewhere over the next 20 years, there's going to be another big correction. It might happen in 10. It could happen tomorrow. We don't know. And what are you going to do about that? If you get a big drop, what are you going to do? And my answer is look at the potential decline in your stock portfolios. Now, do you know those exactly? Well, if you're only holding 4 or 5 stocks, no, you can't, because you don't know what's going to happen with those 4 or 5. If you're looking at funds that represent broader stock market indexes, it's a little bit easier. Actually, it's a lot easier. But you can take a look at what they've done in the past, what were the economic conditions of the time, why did they do what they were doing, and what you're going to see if you studied it closely is that markets have a tendency to go way past where they should be going in both directions. They go up further than they should. They go down further than they should. And obviously, if you knew where they should be, based on just some pretty simple math, that's something that we'll talk about if you decided to set an appointment and come in, and give a pretty decent idea of a range of prices that you could expect to see. And that's a key. If you are expecting to see 2008, big correction in 2008. And we're looking at, actually, there's a big correction just last year too. And but we were looking for that because we're always looking for that. What am I going to do? This is why we held a third or more of the money in short-term bonds. Why? Because we were rebalancing in 2008, and it's unbelievable how long ago that is, and that I can still remember that. The correction actually started in November 2007, and it bottomed in the first quarter of 2009. So you're talking about right around 18 months or so. 18 months of markets just dropping. That hasn't happened for a while. It actually happened again if you go back to December 21, and then it bottomed here in looks like that one was just a year. It's in November of 22. It was a big drop, though. I mean, to go down, let's see, I'm just measuring this with my chart here. That's about 27%. And that's nothing to really sneeze at. But it bounced back up. And then, of course, you got this last correction that came up. It started in, looks like end of February 25. That one wasn't too bad from top to bottom. I mean, there were a couple of days there, actually one day. It was down almost 20%. And see, the problem with having that volatility there, if you've got 100% of your money in stocks, and you should never do that unless you're like really young and really aggressive. But that's one of the reasons that when I started doing the annuities, I don't know, probably 6-7 years ago now, I'd stayed away from them for a long time. They really weren't that competitive. And you could get, there were alternatives at that point in time that I felt like were more competitive. Now they're really competitive. The interest rates that you can get that are guaranteed, and there are some products out there that will guarantee that they'll go up. They give you 10 years, and each year there's a guarantee that the income will go up. Okay? As long as you're not taking it. It's not while you're taking it. And that's the and that's the hard part. I feel bad. This is what people want. They want something where the interest rate goes up every year. Okay? They don't want any fees. Okay? They don't want any penalties if they pull out of it, and they're just never going to get that. That does not exist, except in your dreams. But anyway, I got a few seconds here before I got to take a real quick commercial break. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. When we come back, we'll actually start to look at some of these stocks that are coming up on scans here for you stock pickers out there. And we've got a whole bunch of other topics. Again, this is Bill Bullington right here on 1420. I'll be back right after these commercial messages.
Got CDs.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to get in touch with me, you can go to my website. It's bullingtoncapital.com. Yeah, that's probably the easiest, quickest, best way to get a hold of us is just go to the website. There's a form on there that you can fill out. Or you can just call us at 330-664-0700. That's 330-664-0700. Or you can just email me, bill@bullingtoncapital.com. And I got to tell you, last few years, the internet, we've been getting intermittent outages. Isn't that aggravating? And I know it's not just me because I'm talking to clients all the time. And it just blows my mind that stuff is still happening. I'm like, come on, guys. We pay a lot of money for that. And but I understand. It's because more and more and more bandwidth all the time is required. They have to have more capacity for every year. You know, there are the new generations coming up. Somebody's getting a year older. I was at one of my granddaughter's events here. She's just in first grade, I think. And wow, I couldn't believe how many of those kids had cell phones. And it's pretty wild. So the demand for bandwidth, and I guess my point behind this is that, you know, you get an awful lot of people who think that, you know, this is it. This is going to be the end. No, you know, for my entire career, I've had to talk people down off ledges. It's just part of the job. Being a financial advisor, people read too much. And I got to tell you, the future that I'm looking at, I just wonder how they're going to have, I don't know, I know they'll do it, but how are they going to have the money to develop all these projects that are going? How are they going to collect the tax revenue to pay for all that? Private industry's got no problem raising funds, and so that's good. That's a really good sign, and it's going to be there. I mean, you're going to have growth. We will not be doing things the same way. In fact, I'm surprised that I still have radio listeners, so I want to thank all three of you. Just kidding. But yeah, I'm amazed. By the way, this is done as a podcast, you know. So if you want to go in and go to Google or go to YouTube and type in Bullington Capital Report, they do post it, and so you can see that. If you really if you have questions, though, I would probably just go get the phone number. Again, 330-664-0700. It's right on the website. Call us. I'll be glad to speak with you and answer any questions that I can. If you want to get a plan, I've gotten a couple of they're relatively new portfolios, and these are, I don't think I'm ever going to need anything outside of this because it really touches all the bases. There's one that I really like from Fidelity. There's one I run myself through Goldman Sachs, and it's nice. It's nice to know that, you know, I've got all the bases covered. That's kind of key. And we use extremely low-cost funds, so total costs are very competitive with just about anybody in the marketplace. And if you go, that's one area where, you know, you'll get firms like Vanguard and whatnot tell you, oh, well, we're the cheapest. Yeah, you are. And you're going to do most of the work yourself. We've got financial planners. Yeah, I know. And you're not allowed to give a lot of the advice that people are going to have questions on. So I've been around long enough to know that too. And it's not often. And quite frankly, it's really normally when you get questions that are really difficult to answer is because you need to bring in a CPA or an attorney. And so we can help you with that as well. I can give you recommendations to people if you want to see them. And so we can go from the extremely simple to the extremely complex. And the hard part, anyway, to me, about managing money is looking at how many times you're going to be wrong. The market head fakes and individual stocks head fake all the time. What do I mean by head fake? Well, they drop precipitously, unexpectedly. How about that? Those words have lots of syllables in them. I normally don't do that, by the way. But anyway, so you just have to be prepared for anything because anything can happen, and at some point in time, it probably will. And that hasn't changed since I first got my license way back in the 1980s. It's the same thing. I probably shouldn't have told you it was late 1980s. Actually, it was the very late 1980s. And yeah, but it hasn't changed. The only thing that's really changed, and people will say there's more speed now. Yeah, well, back in those days, there were 11,000 stocks listed on the major exchanges. Now there are 3. Think about that for a second. So what does that change? Well, there aren't as many options. So everybody's looking at the same 3,000 stocks. And by the way, I think there were a couple thousand funds at the time. Now there are more funds than there are stocks. So that's a change. And what does that equate to? Well, what it means is you're actually going to have to be a lot more patient. It's when everybody knows what's out there and they know what the calculations are for when you discounted cash flow to get an idea of what these stocks are actually selling for versus what they should be selling for. So they don't get out of alignment all that often. That's a key. They don't get out of alignment all that often. So if you want to get a good returns, you don't want to have to lay awake at night and wondering. I would probably go with some of the institutional managed accounts. If you want to see them, hit me up. Call us. Come out and see us, or I'll meet you somewhere. I'll show you. And it's the meeting is there's no cost to it, and I speak the same way in one-on-one that I'm speaking now. So, if you don't like me, don't call me. But I'm here to help. When you work as an advisor, when your clients do better, so do you. So I'm on your side. And this stuff changes like the wind, and it's just mind-boggling. I always thought at some point in time they have got to realize the folly in changing the rules that frequently. Nope. That message just got lost. It never came to be. And if anything, they're changing them more frequently because it's a lot easier now. Everybody's on the internet. And, that's all computerized. But so there are a lot of basic rules. One thing that will never change is that stocks can only move in one of 3 directions. They can go up, they can go down, or they can go sideways. And that hasn't changed. So unless we get 4-dimensional graphs, they're not going to. And what causes stocks to go up? Well, a company's grow in value in the long run. In the long run, it's sales and profit margins. In the short run, it's all rumor. So that's what makes it really, really tough, because in the short run, stocks, when the short run is anything less than 5 years, by the way, and I know nobody wants to hear that. In fact, the short run's actually closer to anything less than 10 years. And I really know nobody wants to hear that. Well, unfortunately, that's the way it is. So if you don't want to know the truth, don't ask me. So there are a lot of people out there that'll tell you exactly whatever you want to hear. And I'm going to try to prepare you for the future because hopefully we're all going to see it. And I don't know, I'm getting up there. Just kidding. Kind of. But yeah, it's some very basic rules, very basic models. I have this one model. I love this model. I probably should have never put it away. I know I shouldn't have. So the model is like this. I took the Russell 1000 Growth Index. Okay, they go through the Russell 1000 Index and rank them all by sales growth and profitability, and speed. Okay, and I just took the top 40 out of that group. And once every 90 days, that one I think is a monthly. I'll have to double check. I have so many of these models I forget sometimes. But anyway, we rebalance it throughout the year, and talk about performance when the market's going up. Yeah, you're in the stocks that are growing the fastest, that are going up the fastest. That's what you're in. Okay, and yeah, it's pretty nice. Now, when the market's going down, you're probably going to wish you'd never heard of that strategy. And a lot of people go, well, you know when that's going to happen, right? So you can get out ahead. No. If I knew that, Warren Buffett would be begging me for tips. Nobody knows that. And that hasn't changed either. And you know what really hasn't changed is the opinions of the general public for investing. Yeah, they still, for some reason, and at some point in time, now I take that back. There are a lot of people that eventually go, oh, okay, now I get it. Yeah, so it's a lot of work. It's a lot of work emotionally. It's a lot of work psychologically, and it's a lot of work intellectually because you got to study it first. Then you have to start building the models. And then once you've got the models in place, you need to run them. So that's why I have a job. And most people don't know that. Or would you be fine just buying a couple index funds? Well, as long as you don't sell at a bad time, as long as you keep adding to it, and the market's going down, I'm pretty happy because I'm still putting money into my accounts and heck, I'm putting more money into my accounts each month now than I did when I was in my 30s, even as a percentage of my income. Well, and that you should be able to do that because your kids are gone. Kids are expensive. I don't know if you knew that, especially when you have 3 girls. Yeah, they're really, really expensive. I feel bad for an awful lot of people today. It is important that you get. You need to get some pretty good strategies. You need to stick with them, and you need to do it for a few decades. If you do that, you're going to be fine. You don't have to start big, and you just need to start. And most of the funds that you have in your 401ks or 401 or 403bs, they're fine too. And in fact, you're not supposed to give out general advice to the public when you do what I do. But I'm going to tell you that the average balance fund does better than the average investor does in the 401k or 403bs. Again, if you want to beat that, the price that you have to pay to get better performance, other than the management fee, because that's in addition to that, but you're also going to pay in the psychological area of the volatility that you're going to see. It's not free. You don't just whoop the market up, because it's easy and you're not going to have any more volatility. No, you'll probably have a little bit more volatility. Not going to kill you, depending on who you are, by the way. But, if you've got a decent risk tolerance, if definitely don't put in anything more than you feel like you can tolerate. And I'm going to give you my formula. I've been using this since I started my practice. Now, I've just noticed some of the biggest vendors in my business, what I mean by vendor, people that provide services to financial advisors like myself and stockbrokers and financial firms. After all these years, I think it was like 3 or 4 years ago, and I've been doing this, like I said, it's over 30 years now. After all these years, it was a couple of years ago, they finally came around to my questionnaire that I've been using for decades. Why did I use it? Well, because he couldn't understand theirs. They had so many questions, and everybody's like, well, I'm not sure how I should answer that. And I'm looking at it and going, I'm not sure how I should answer that. And that makes no sense at all. And it was just a bunch of garbage, basically, that the SEC was forcing on people and FINRA, and to make them try to make promises that they couldn't keep. And shame on them guys. But anyway, they all went over, and this is basically it. So I'm going to tell you what it is. Sit down and add up all your assets together. Okay, just add them all up. This is what we do. We sit down and we add up all the assets, and then we take a look to see how much is invested in stock mutual funds or ETFs or individual stocks. We look to see how much is invested in fixed income, which would include fixed annuities, bonds, bond funds, CDs. Bond funds act more like stock funds, by the way, but we'll try to account for that. And you just write down, see what percentages you have in each one. For the stocks, take off 50%. Okay, so what am I saying that for? Well, because in a bad correction, that's how much the market's been down. It's 4 times in my lifetime. And I'm not 80 and I'm not dead yet. So if you said, well, it averages every 20 years, yes, it does mathematically. It wasn't every 20 years. There were a couple of them that were very close together, and then they were spread far apart. So that's the on average, so the average is really not telling you a whole lot there. What it's really telling you is that, every once in a while, market can drop quite a bit. And if you're not prepared for that, well, you should be. And I got to take a real quick commercial break here. So when we come back, we'll talk about how do you prepare for the next correction. Now, anybody can find good performing stock funds or stocks. How do you prepare for the next drop? And we will talk about that when we come back. This is Bill Bullington. I'll be right back in, I don't know, probably 2 minutes.
I know a place where we can go to lay the troubles down, eating your soul. I know a place where mercy flows. Take the stains, make you whiter than snow. Like a tide, it is rising up deep inside a current that moves.
And we're back. And I was just, I've had a Wall Street Journal subscription, digital, for about, I don't know, since they began. So a couple decades. They just removed all my information and said you have to you got to re-sign up for all this stuff. And now they want to do the email, and then they want you to go to the email and get this code and bring the code back to the, it's just so aggravating, especially when everybody's doing that. There are no services around that I can think of. And then they don't work. I mean, they get stuck. And then when you finally get a hold of somebody on tech support after 40 hours of hanging on, they're like, oh, yeah, well, we had an outage and then we had this. They got a good excuse. Actually, it's not a good excuse. It shouldn't happen to begin with. You shouldn't roll stuff out until it's ready. That's a big difference. That's a huge difference. And I should have seen this coming, though, because it was happening with service providers that we have over the years. They come out with something, and Bill Gates was the one that started this whole thing off. He said, no. You don't have to go through and fix everything. Send it out to the public. They'll tell you what's wrong with it. Do you know how frustrating that is? They're doing their maintenance or checking the code based on the amount of complaints that they're getting. Anyway, I guess I'm just from another generation. It's supposed to work. You're not supposed to be able to sell it unless it works. Can you imagine? Yeah. Can you imagine them selling jets? Well, we'll fix the problem when we see a crash. You know, that's basically what they're doing without a plane. Anyway, I'll stop complaining. But and I am thankful that we have a lot of stuff, but a lot of stuff that has come out lately, it's really not all that helpful. A lot of the stuff I've been using now for, I don't know, probably a couple of decades. I'll tell you what is helpful, though. If you know what your risk tolerance is, and again, I've been using this from, since I got in the business. Here's how you figure out what kind of risk taker you are, right? And I'll cover this at least once a week, so you can, if you miss it now, don't worry about it. You can tune back in. But write down the amount of money that you have in all your investment accounts. Just write it down. Add it up, write it down. Now start taking percentages away from that. Well, let's say, to keep the math simple, it's $1 million. Okay. Or 100,000, whatever you got. Let's do 100,000. So you're saving, you got 100,000 bucks. If the market were to go down, if it was all invested in stocks and the market was down 50%, that'd be down to $50,000. If it was $1 million, it'd be down to 500,000. That might be too much. And for most people, it would be. For me, it would be. I don't want to be down 50%. And by the way, well, can't you see and make changes? Hell no. Sorry about that word, but that's how frustrating that is. You're not going to be able to see it coming. You're going to have an idea. And if you ever measure that, and this is what I would recommend. Write down what you think you should be doing. Don't do it. Write it down and track it. Do that for about 6 months. You will never do that again. You're going to be so wrong for so long, and you're going to miss so many times. You're going to, oh, wow. And you might even have to do it for a year these days, because I know nobody does anything for 6 months straight. Do it once a week. Do it once a week for a year. Just write down somewhere what your opinion of the stock market is, where you think it might go. After you've done that for about a year, okay, you will never do that again. Why? Because you're going to be so frustrated. You're going to see how useless that is. And it's so what do? Well, you do what I've been doing. And what now, one of the biggest, Orion, they provide financial services to people like me. They're the biggest, one of the biggest in the world. Billions of dollars in revenue. So they're using the same questionnaire for risk that I'd been using for minimally 20 years before they started using it. And they were giving everybody such a hard time. Oh, no, you got to know your client. There are rules about, you got to know your client. And they had all these questionnaires, and they thought that was protecting them. And the clients didn't have any idea how they're supposed to be answering it. And neither did they, by the way. But it was just a useless scheme, basically, just so that when the market went down, if somebody filed a complaint, they would bring that questionnaire up and say, now see this? This is what you said. And I think you should understand that. So here's the other way to do it. Take a look at your portfolio. Take a look at the S&P 500, Russell 1000, Russell 3000. Look at the peak, and then look at the troughs of the major corrections that you can get access to. I have this software. It's called Telechart, and I have a Bloomberg terminal, a bunch of stuff, bunch of data. I don't know if Yahoo Finance has this, so I'll go look this week, and I'll report back next week. But the bottom line is add up all your investments, all your investment accounts. Start taking off percentages. Take off 10%. How do you feel? That's just so that I can keep the math easy. Let's say you have $1 million. So if you take 10% off of $1 million, that's 900,000. How do you feel? If you take 20% off, it's down to 800,000. Now how do you feel? Okay. Where could you go where you wouldn't be too upset? Okay. In most cases, a lot of people are going to be 10, 20%. Okay. If you can only take a 20% decline, that means you shouldn't put more than 40% of your money in stocks. Why? because if you get another 50% decline, you're going to be down 20%. What's half of 40? 20. So if you put in if you've got more than 20% of your money in stocks and you have more than a 50% decline, you're going to be down more than 20%. So will you make a lot of money with only 40% of your money in stocks? Probably not. It's going to hurt your performance. It's going to hurt your performance. Well, I don't want to do that. Well, then you got to work on your risk tolerance. You got to plan for that psychologically. But what if, well, this is what I'm saying. Plan for it. Okay. I can't give you that. I can't take what I feel and transplant that. I'll try. But no, I'm just going to tell you. And why am I so confident about this, by the way? Something you may have noticed is like there are only a fixed number of things that you can do with your money. Okay. And until Mars gets populated and opens up their own stock exchanges, you're kind of stuck with what we got here. And the money is not going away. Once they print money, the money's there. Once they've issued that out, the money is there. So the economy is going to grow, and a large part of that's due to the Fed's monetary policies. Okay, I'm not going to get into all that right now. Maybe we can talk about that a little bit next week on the show. But the bottom line is, stock market, if you're looking out over 10-year time periods, say rolling 10-year time periods, what does that mean? Well, if you looked at 2000 through 2010, that's a 10-year time period. 2001 through 2011, that's another 10-year time period. They call that a rolling 10-year period. So you went from 2010 to 2001 to 2011. You rolled right up 1 year. So if you look at those rolling 10-year time periods, there are very few of them. There are some, but there are very few of them in the last 100 years or so that have negative returns. And a large percentage of them have returns that are better than bonds or CDs. So that's why we do stocks. But is that a guarantee? Heck no. You can't guarantee that stuff. That's one of the reasons that you hear me talking about annuities, which I will not have time to get to today, is because annuities will offer a return that's typically higher than what CDs or treasuries are. Now, the catch is, once you're in that product, you're going to want to convert it into an income stream at some point in time, or you're going to look to pass it on to your beneficiaries, and you don't want the risk of it being down 50% like you would have in the stock market. So it's all about risk. And that is the key to being a successful investor, is controlling the risk. And back to that question, how much are you willing to be down? How much are you willing to be down by? Take that money, take that number. So let's say yours is 50%. I'm willing to be down, let's just say 40% or 30%. I'm willing to be down 30%. All right, so 30% is half of 60%. So if you put 60% of your money in the stock market and it had a really bad 50% drop, you're only down 30. See that? See how that works? I can't tell you how long I've been using that. And it's just mind-boggling that it took the entire industry, 25 years to get to the same point. So now I've basically taught all you guys. And by the way, if you're listening to this one, you're another financial advisor, feel free to borrow that. I'm absolutely sure I wasn't the first one that came up with that. It's just that it made a whole lot of sense to me. And I'll tell you why it made sense to me, because way back in 1987, when I first got licensed, I read a book, and it was by Peter Lynch. You might know who he is, and maybe you don't. You probably don't. Well, anyway, this guy had the best track record of any money manager for the longest time, and I think he still holds the record for the best overall returns for his tenure. It was 13 years, and it was close to 30% a year net of all fees. That is mind-boggling. I don't think you'll ever see that again. Anyway, he was the one that said if you can't stand to see your stocks drop by 50% or more, don't buy stocks. And I was thinking to myself, what? Is that? Holy cow, nobody had ever said that. That was missed in the training I had in the 6 weeks I had to spend in New York City. Literally. That was the training back in those days. You had to go live in New York City and get up and go to classes every day and get back to your hotel room around 6 at night and study, then get up and do it again. There's a lot to know about the industry, and there's more now than there was then. Actually, they had more funds then than they do now. But anyway, I've got about 4 minutes here. If you have any questions for me, you can always send them at bill@bullingtoncapital.com. That's my email. You can go to my website. There's a contact us page there too, and it's Bullington Capital. I would probably try to call I would probably try to call and leave a message. For some reason, we use some of the biggest vendors in the industry, and the email just gets so jammed up sometimes it probably takes a lot longer for us to get back than it does if you just call. So anyway, I got about 30 seconds here. And again, this is Bill Bullington here every Saturday morning from 11 to noon. You can go to my website, bullingtoncapital.com. And all my contact information is there. If you have any questions, feel free to reach out to us. And I hope you guys have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.